Coming up on this episode.
What is venture capital? What is a startup? How do startups raise money?
Private equity is the same as venture capital to a certain extent, only that they're investing in much bigger deals and they need to be more mature.
Where do these valuations that tech startups generate come from?
They're not selling you what is there today. They're selling you what the future looks like.
What are some of the things you would let entrepreneurs know?
I think for local founders, number one, traction is very important. Mm-hmm. The biggest challenge an entrepreneur faces is how they spend their time.
You have to know how you're going to add value to this institution before you decide to get into it. Ladies and gentlemen, welcome to the InVhestia Investment Show. My name is Rina Hicks and I am the Operations Director at FIDA Investment Bank and your host on the InVhestia Investment Show, where we showcase different investment opportunities just for you. Did you know that last year, 2021, Africa raised $4.4 billion in venture capital? We'll be looking at venture capital generally. What is venture capital? What is a startup? How do startups raise money? And all of that lovely stuff. So this show is specifically for those who are looking to invest in businesses, as well as those who are in business and wondering, where do I raise capital? So we will be looking at that. I am so thrilled to have with me Stephen Gugu. Stephen Gugu likes to see himself as an entrepreneur, as an educator, and as an angel investor. But he's so much more, and we're going to get to know him in a little bit. Welcome to the show, Stephen.
Thank you, Rina.
Yeah, it's so wonderful to have you. I have, interacted with you in so many different levels. You are my lecturer at one point,
yeah.
Which is so awesome in the course at Strathmore. So it's so good to have you on the show. But before we get into the subject of the day, I wanted you to tell us a little bit about who you are in your journey in this space of investing.
Yeah. That's a question that I can take quite a bit of time to answer. But maybe where I should start it from is I sort of like started learning more about investments in my first role, where I was working at Stanbic Investments. And this was an asset manager. And we used to invest pension funds in the stock exchange. But we also had a bit of leeway to do some alternative investments. So we'd look at some private equity investment, real estate investments, and so forth. But then after spending 5 years in Stanbic, this was way back in 2010, I felt that it was too, I like using the word sanitized, in the sense you'd sit in the office, you'd analyze companies, etc., but you didn't spend as much time with entrepreneurs. So I wanted to spend a bit more time on the action side of things. So I went to do my MBA. I did my MBA in Belgium at Blair Business School, and there was a lot of emphasis on entrepreneurship. And I would say that that's where my interest really sparked. And so from that point, when I came back to Kenya, in 2011, I didn't want to go back to sort of like the corporate world. I said, you know what, if there's a moment to start something, this will be the moment. And so then what I did is that I started a company called InVhestia Africa, where we would be doing advisory work for entrepreneurs. This would be in terms of fundraising, M&A, financial modeling, all those different things. But then I also started something else, which was just out of passion, which was really just coaching entrepreneurs, spending a bit of time with entrepreneurs. And so I remember back then I would spend every Friday at an incubator, just listening to startups, giving advice to startups. And I joke and say that I might have killed so many startups during that time because all my experience was in corporate, but then I was giving advice to entrepreneurs.
Oh yeah, because you weren't an entrepreneur yourself by that time,
exactly.
Or you were just starting. I
was just starting, but also I feel like it takes, for you to give very credible advice to entrepreneurs, it helps a lot if you've walked the journey, right? Where if you tell someone that this is what you should focus on, because what the biggest challenge an entrepreneur faces is how they spend their time. And the entrepreneurs who make it know how to spend their time on the things that have the maximum amount of leverage. Yeah. So that's why I joke about that. But then through that coaching and working with entrepreneurs a lot, then I got into this tech ecosystem, really understanding what startups go through, their fundraising journeys, the different stages, and so forth. All along while I was doing all that, I was also teaching at Strathmore. And I spent a bit of time at TSA Business School, where I did a short course on entrepreneurial financing. Now this course was looking at how to finance venture capital type startups, how to work in venture capital and so forth. And so I took that course, I brought it to Strathmore, and we started offering it.
Oh yeah, that's the one I did.
Yes. But now we had two at that point. We have one which is called private equity and venture capital, which we teach at the business school. And then the other one I created, and we were teaching it for fourth-year students, called Entrepreneurial Finance. And what we would do is walk through the life journey of an entrepreneur from an investor's perspective, how to analyze deals, how to value deals,
For fourth-year students.
Fourth-year students.
Fantastic.
Yeah. And so you'd argue that then I was teaching part of it, I was entrepreneuring part of it, if you want to call it that. And then it's only much later in 2016 that I got into the bandwagon of angel investing, which was then again, you do something for a number of years, then you ask yourself, okay, we are teaching quite a bit of entrepreneurs about how to pitch. We used to organize investor days for them and so forth, but we were not getting as many deals going forward.
Okay.
So the key question was, why is this happening, right? And when we spent time, we felt that one of the big issues, there's a lot of money out there, but for as long as we don't have local capital that is interested in investing in startups, we really won't crack getting more local founders capital, right? The example I would use is that we would take entrepreneurs up a cliff, we teach them how to pitch, we tell them, this is how you prepare your business model, etc. Get them on top of the cliff, then they tell us, where is the parachute? And we tell them, oh, sorry, we don't have that. You just have to figure out how to get back down, right?
Yeah.
And so then we felt, let's go for angel investing. Yeah. And I started making a few deals myself, made a couple of deals, but also now starting educating angel investors or people who are interested in this space in terms of how to evaluate deals, how to source for deals, how to make investments. And that has taken me now in a different direction altogether. We've during COVID, we created something called the Africa Angel Academy, where we train a lot of angel investors. We've trained, I think, last year we trained 212 angel investors. 212? Yes, from across 10 African countries.
Oh, I see.
This year we want to train, we already have 164 that we're going to be training.
So who does the training, InVhestia or?
So what we do with that, and maybe I should, my life is crisscrossed. So the entity that is in charge of early stage investing, which I don't run at the moment, is called Victoria Ventures.
Okay.
So we have a team that runs with that.
Yeah.
We have an angel network manager, who runs with that. We have an analyst who sort of analyzes the startups and so forth. But now this is, it's online courses that we've created for any angel investor. So you can go to africaangelacademy.com and you'll be able to access those courses. But then I think I've jumped so fast, so far ahead of that. But we've kept then now practicing that art. So we work a lot with entrepreneurs from the perspective of fundraising, from the perspective of helping them to prepare their documentation if they want to go meet with investors. At times you're working with investors on the other side and you're helping them in terms of being able to analyze deals. We're trying to make angel investments ourselves. So that's how I ended up in this field, so to say.
Wow, fantastic. So there's somebody who's heard you describe your journey and had venture capital, angel investing, and these terms that perhaps they may never have heard before. So maybe we can start with you kind of giving a definition or an explanation on what is venture capital and what is angel investing.
Okay. So how I like thinking about investing in the tech innovative ecosystem, if you want to call it that, is that it's almost like a ladder, right? Or a staircase, maybe a better is a staircase.
Okay.
So when you think about raising money the first time around, if you found your business today, the first one is probably you'll invest your own cash. Then after that, you'll probably go to your family and friends and they'll put in some cash. That's sort of like the next level. And if the business then grows further, then you can start talking now to incubators, accelerators, etc.
So some examples of incubators and accelerators would
So there's Strathmore, IBIS Africa, they have that. There's NILAB, there's Pangea, there's Growth Africa. I'm talking about the Kenyan ones in this case. Yeah. And usually maybe those would come in before, or at times you could even go to an angel investor, right? I was an angel investor. An angel investor is just someone who's interested in making investments in early stage opportunities. They like the thrill of finding an early stage opportunity, polishing it up, where they see where the opportunity lies in future, doing a lot of mentorship, introducing their connections. Because at times the biggest thing that the entrepreneur needs is, can you make a phone call to someone? Networks, right? So they do all that. And then the next staircase, so to say, would be, VC funds. And there's different types of VC funds. And so that's where the terminology now starts getting a bit more crazy. So you have then pre-seed, seed, Series A, Series B.
I had that as a question because I've gotten so confused over time. But let's finish with the venture capital and angel investing. Then you'll tell us about those levels of fundraising. Carry on.
And the reason I introduced that early is because different venture capital funds participate at different levels.
Okay.
Right. So these venture capital funds will do seed investments. There's venture capital funds that will do Series A investments, Series B, Series C. And the way to think about it is the company is growing, so they need more cash. Yeah, they're also more mature at different stages. So there's venture capital investors that feel comfortable analyzing or investing in more earlier stage companies that probably need, and maybe if you use sort of like amounts, and I'll put this in shillings. So if you're thinking about maybe a seed, people
There's
are
even
saying
pre-seed.
there's even pre-seed.
So who comes in pre-seed? It's the family.
The angels will be coming at that point.
The angels are pre-seed.
The angels will be coming
Okay.
at that point.
Okay.
But then, I mean, okay, so maybe let's just draw two lines, right?
Okay.
There's investors on one line,
Okay.
and then there's terminology on the other line.
Okay.
Right?
Okay.
So angel investors are the earliest investors. After that, you have venture capital funds, right? Venture capital funds are not investing their own cash. They're investing money that they've raised from external investors. So
Like private equity funds.
Yes, private equity. Yeah, but they've raised their money from pension funds, from insurance companies, from family offices, from high net worth institutional investors. It depends, right? So that's where the source of capital is coming from. But they're not investing their own cash.
Yeah.
Angel investors are investing their own cash. Yeah? Now the next level after venture capital, and we're speaking about investors now, is private equity. Yeah? Private equity is the same as venture capital to a certain extent, only that they're investing in much bigger deals and they need to be more mature, right? So I'm sure you've had, this company, that the infamous WeWork, right?
Yes,
Yeah?
yes.
In the US,
Yes.
that was raising billions of dollars, and was raising these from a private equity fund, which I don't know whether it's called VC or what, SoftBank, and they would invest $5 billion. Those kinds of significant
That's
amounts of
private
money.
equity.
That's private equity, right? And even in our markets, we have private equity. But anyway, I'll come back to that. So that's the lane of investors. Then after private equity investors have come on board, the next expected thing that happens is either you exit in an IPO. We've had several IPOs in Kenya. Or you have a big institutional investor, not institutional investor, but strategic investor who comes on board and then buys you out.
Yeah.
And that's sort of like the journey from an investor's perspective.
Yeah.
Then on the other side, there's terminology now.
Yes.
Now, terminology it also follows that same line, if you want to call it that.
Yeah.
But then you find that the investors now are getting very tricky. They don't want to be pigeonholed. So you're finding these institutional strategic investors who are doing seed investments.
Oh.
They're doing Series A investments.
Okay.
You're finding these venture capital funds that are investing significant sums of money, and that's where then terminology confuses to a certain extent. But basically, if you want to speak about amounts, you're really saying that if you're thinking about pre-seed, a company is raising maybe 5 million bob, for argument's sake, to sort of like, let's say, let me speak in dollars because it's much easier to think about
in
that.
dollars, it's fine.
So it's sort of like $50,000, sort of like maybe $300,000. That's maybe a pre-seed, or even
so that's
500,000.
Yeah.
5 million bob, maybe sort of like 30 million bob, of,
Okay.
50 million bob thereabouts.
Okay.
So they'll call that then, seed, where seed pre-seed, that range. When we move to Series A, you're really speaking about companies that are raising maybe $1 million,
Wow.
maybe going up all the way till $3-5 million, right? And these things keep changing based on the market and so forth.
Okay.
When you speak about Series B investments, it's much bigger sums of money. Yeah. So for instance, we had Cellulant that raised money. I don't know whether that was Series C or something like that, but they raised $48 million.
Look at that.
Right? So that's a much bigger jump in this case. I mean, there's so many startups that you've had raising $1 million, $2 million, $3 million in our ecosystem, right? I think we had this startup found called Kidato.
Yes, I know Kidato.
Yes. And they were doing a seed round.
Yeah.
I can't remember, but it was probably $1 million or $2 million, something like that.
1.2 million.
Exactly, right? But then they call that the seed round. But that's because they've not raised other levels of financing before that. And so it has to be called a seed. Then they go for the Series
it's the
A.
first one
It's a fast
doing.
round, so to say.
Okay.
So that's where the terminology gets confusing. But the idea to think about is that you move from pre-seed to Series A, B, C. But there's nothing that means that you have to do all the rounds, right? There's companies that will not do a pre-seed. And maybe the other thing is that pre-seed is you're saying you're doing a proof of concept. So the company is still yet not proven. The seed stage comes, you have a proof of concept. Series A comes when you're trying to scale the business.
Okay.
So that's another way of thinking about it, but it keeps shifting.
I think that's easier to think about it. So, and also just knowing the number of raises somebody's done. So when they say we're doing Series C, then I know, okay, so they've done A, B, probably seed A, B, and now they're on C. Okay.
Exactly.
Okay.
And there's a nice resource that someone can access.
Okay.
So as I mentioned, we have an institution called Victoria Ventures.
Yeah.
Now, if you go to our website, www.victoria.co.ke.
And Victoria spelling is interesting.
V-I-K.
I remember that about it. V-I-K.
Yeah.
Then Toria.
Yeah, Victoria, .co.ke. We did something with the UK Kenya Tech Hub. And this was just a guide for someone who wants to understand early stage investing, especially focused in Kenya.
Okay.
Where then we define terminology, amounts, process of investing, etc. So that's a good resource for someone just to jump into and just double click.
That's helpful.
Yeah.
Okay, so maybe where we can go next is I'm an investor. I don't have much money. Okay, maybe I have 500,000 shillings. Is there any space for me, or maybe 500,000, a million shillings? Is there any space for me to be able to participate in this asset class? Because investors are like, look, the stock market, yeah, I know, but I'm not really keen because it doesn't give me that much of a potential rise in my return. I can put my money in bonds, but I want to take a bit more risk. I want to diversify a little bit and perhaps get into angel investing.
Yeah.
Where can they find information about the companies that exist at the moment?
Yeah. So, maybe the two aspects, the two ways of thinking about this. There's first of all, there's your typical angel investor. This is someone who doesn't want just to be a financial investor. And when I say financial investor, it's someone who invests in a stock in Safaricom. You really don't care what happens in Safaricom. You know, they have their CEO, they have their structures, they're making their money. All you want to just know is that my dividend check has come in. You want to make sure that the story just keeps going well. So when they're announcing their financial results, you want to sort of like see where they're at and so forth. But you're not involved from the company's perspective in terms of what's happening. Now, but my argument has always been that if you want to be a financial investor, don't do it under angel investing, right? Because it's risky, right? It's almost like taking a gamble to a certain extent, right? If you do it as a financial investor, where you just go to a platform, you put in your cash, because then, you know, what are you doing? You're first of all trusting that the platform is able to review deals very well for you, that they'll allocate the deals really well for you in terms of the deals they're going to allocate your cash. And there's platforms that do that, and we can come to that in a second. But then the second way, where you come in as an angel investor, and where you're really not a financial investor, you're an angel investor who's also involved strategically, operationally, etc. So you're opening up, you're doing a lot of mentorship, you're opening up your networks for the startup, and really what you're doing is that you're creating your own value. Yeah. So you're only investing in companies.
You're creating your own value.
Exactly. Because you're investing in companies that you think you'll be able to add value.
Wow, okay.
Right? So one of the companies we're investing in is called BuyMo. And what they do is that they seek to digitize, you know, not the supply chain, but they don't digitize. If you're a wholesaler, in fact, they call them service purveyors, and you're interested in terms of understanding your value chain. So when you release your products, where do those products go in terms of how many retail shops have that Dukas, have that product, how much of that are they selling, when do the stockouts happen, and so forth. And you know, they came up with these interesting stats that I think I can't remember that stat right now, but they're saying something to the extent that as an service purveyor, you lose a lot of income just out of the opportunity cost, the fact that your product is not there. And so what they're trying to do is to make sure that you can push your product much faster. And of course, they're also adding value to the retailer. Now, one of the reasons I invested in that is because I know quite a number of these sort of like wholesalers, distributors, and so forth. So when the company came on board, I could make a few phone calls, and just by making a few phone calls, they would be able to get appointments, they would pitch their product, and you know, their product would be adopted. And you know, it's adopted at that level of the wholesaler. And then after that, of course, the different shops they work with, they push that down to the different shops and so forth. So so there has to be, where is the value coming from? So if someone came to me today and told me I'm doing a gaming startup, it's really fascinating, etc. Unless I have another angel investor that I trust who understands the gaming world really well, I'll probably not participate because I don't know how I can add value to that entrepreneur.
That's really helpful, because then you have to know how you're going to add value to this institution before you decide to get into it.
That adds a lot of value in the process. And then also you need to spend time with the entrepreneur. So it's not just about putting your cash, it's also about having coffees, right? or just a meeting, every month, just saying, okay, what are your big challenges? Where can I support? And they tell you, what, we're trying to get to these networks, 1, 2, 3. Do you have those networks? You say, yes, I have those networks. I can call this person. We can set up a coffee with them. We can try to unlock that. And so by so doing what you're doing, if you remember my staircase, you're trying to move them to the next staircase, because the game that is played in this world is that you need to hit certain milestones to raise for the next round. And what you don't want is to say that, in the next round, for instance, for BIMO, they have like 5,000 merchants. You don't want to say in the next round we'll have 10,000 merchants, and then people come for the next round and you have 2,000 merchants, because then your valuation goes down, right? So you always want to be making sure that you're adding value, moving from one step to the next to the next.
You mentioned valuation, and I'm reminded of a conversation I had with an entrepreneur not too long ago, and it's a tech startup. They probably have less than 1 million shillings in revenue.
Yeah.
And so it was okay, so they want to raise money. How much do you want to raise? They said the amount, and we were like, okay, what's the valuation?
Yeah.
And they said $5 million. I'm like, I'm sorry, what? $5 million.
Yeah.
Based on, knowing our background, you put a model together, you focus to the future.
Yeah.
But you have some basis.
Yeah.
We're in the process of trying to prove concept, and somebody has already decided. So please help me understand, where do these valuations that tech startups generate come from? Yeah.
That's a tough question at times, even for me. But I'll try and paint the picture, because I think it makes sense at some level. So remember I spoke about the staircase,
yes,
right? So how does the staircase work? At every round of financing, an entrepreneur will usually dilute, right? They'll sell some shares, and of course by so doing they dilute. So assuming they start as 100%,
yeah,
when you join as the first investor, as the angel, they'll give you 10%. When I come in as a VC, they'll give me 10% or 15%. When the next round comes in at, I don't know, whoever, private equity, venture capital, series A, B, C, they'll give 10, 15%. So then if you think about it, if you walked in today and they said our valuation is, I don't know, let's say $1 million bob, in Kenya shillings in this case, then you say I'm putting 500,000 bob. So you're already 50%. Yeah. So by the time they're in their fifth raise, they're going to be 5%, 10%. Now, what's the challenge with that? The challenge with that is that the entrepreneur is not motivated, because he's more or less like an employee. It's just like, why should I be the one who's driving the bus? I'm taking all the risks. I'm the one who's having sleepless nights, etc. But as we are doing all these, I'm just a 5%. Like even if you have the best case scenario, Paystack exited at $200 million, I'm just 5% of that. So I'm creating value for other people. So then if you think about it from that perspective, then what venture capital does is that it gives a certain amount of trust to the entrepreneur and starts thinking from the perspective of what are we building? How big could it be?
Okay.
Yeah. So if you assume, for argument's sake, I'm just using an example like a Cellulant. If you say that Cellulant, the biggest it could be is a company valued at, I don't know, let's say $500 million.
Okay.
Right? So if I'm doing the first raise and I'm going to have maybe 4 other raises before I get to $500 million, what should be the valuation today of that first raise to justify that by the time I'm doing the $500 million, I'm exiting at $500 million, for example, that as an entrepreneur, I'll have maybe a 30-40% stake, right? So that's the rationale. So they're not selling you what is there today. They're selling you what the future looks like, right? And so then for you as an investor, how to make sense of it is to ask yourself, how big do I think this could be?
Okay.
Yeah. If I think that this company is not going to be big, right? It's going to be, someone comes and tells you know what, we're raising the first a seed round, which is $500,000 at $5 million. And you're thinking, in my view, this company, maximum they can make it is $10 million, right? Which is just 2x.
Yeah.
Then you should say, no, I'm not going to take a 10% stake for that kind of business.
But how do you even get to the place where you're like, yeah, I think it can get to 10x?
Yes.
You know, just how do you project what could potentially happen in the future? Like, what are some of the metrics that you think through or evaluate? Okay.
The first thing we like doing is, first of all, asking the entrepreneur, paint for us a picture of the future. As
you
you
ask
see
the
it.
entrepreneur?
Yes. Because if they tell you they're 5 million, then you know they should be expecting that 5 raises later, we should be talking about, I don't know, $100 million, $200 million, whatever that might be. So paint for us that picture as you see it, right? And that helps a lot in terms, because you know there's various sectors that you are looking at in this case, and you can't be an expert in everything. So once they paint that picture, then it's for you to ask, does that picture then make sense for you? That's one way of thinking about it. The second thing is just being in the ecosystem, right? Talking to you have to be having conversations with different investors.
Who have maybe invested in similar companies?
I mean, there's quite a number of venture capital funds,
Yeah.
right? I mean, there's your likes of Novastar, TLCom. There's much bigger sort of like funds across Africa that are making investments. So then you want to just be, having conversations, being in those spaces. When you hear these, investors meet up with people, have a coffee, what are you guys interested in? How is that sector playing out? Yeah. There's lots of podcasts, there's lots of newsletters, that you're really like in the ecosystem, immersing yourself. What's happening in the US, in this edu sector, in the ed tech space, where companies are like getting acquired. Like for instance, one of the spaces which is very hot right now is fintech. So if someone is starting a company today in fintech, initial round of valuation is always 2 million, 5 million, 10 million. There's nothing that's happened, but that's where they're starting from, right?
Yeah.
But that's because also like some of the exits we've seen, and one of them that happened was Paystack in Nigeria, $200 million.
Say that again, Paystack.
Paystack, yeah.
Oh yeah, I think I saw that.
$200 million.
Yes.
Some of the angels made like 50x their money.
Look at that.
Yeah. And so you need to understand the space. You need to talk to some of the people. You need to join the spaces that are doing some of these things. So I wouldn't do this sort of like, I'm somewhere in the village, I'm just like, yeah, I like this thing. Let me send this money to this person and see what happens. Because there's also quite a number of companies that would make it. Yeah, that's the other rule of venture capital.
So with Victoria Ventures, does so your angel investors, so how does it work? Do you pool your funds together, or do you show the angel investors opportunities that they then make a decision on whether they want to go ahead and invest or not? Yeah,
we go deal by deal. Okay. So we don't pool funds together.
Okay.
We ask them when there's a deal. We have a day when the startups are pitching. There's some pre-work that has been done. You listen into the pitch. We tell you why we think that's a good deal in our own view, but not giving you investment advice because you have to make up your own mind. It's risky asset classes. And then you choose whether you want to make investments in this case. But before that, we do a lot of education for the angels, for them just to understand how the ecosystem looks like. We have events, right? Networking events. We have education events where, with different topics, right? Could be about just the investment valuation, deal structuring, etc. where you can ask more questions. Could be very topical, understanding, health tech startups, agri-tech startups, etc. what's happening in that space. So we have those kinds of conversations. And not only us, because there's also the Africa Angel Academy that does the same thing. There's the Africa Business Angels Network that does the same thing. There's conferences that are doing a lot of tech related things. There's the Africa Early Investment Summit that happens every single year. And they keep moving. I mean, once you're in the ecosystem, you start knowing about all these different things.
Yeah. Okay. And how does somebody join this network? Yeah.
So there's several networks. So we're not the only network. But if you want to join the network, you can write to us, first of all. So our Angel Network Manager, his name is Jason. So jason@victoria.co.ke. You can just shoot an email. He'll then give you a ring. And then he'll set up a meeting with you just to walk you through. But we charge a membership fee in this case, or $500 per year. For individual members, for institutional members, it's $2,000 per year. And then once you join, then we walk you through sort of like what are the advantages of being in an angel network, etc. We have, and then you start the journey, so to say. And I would propose, before you make any investments, don't get also sold in the hype, right? Because there's also a lot of hype. There's so many, as I mentioned, the rule of venture capital, unfortunately, is that out of 10 companies that will start out, if you sort of like track them down 3-5 years from today, only 2 or 3 are going to be in existence, or even if 5 are in existence, only 2 or 3 will be making lots of sense from the perspective of the returns, right? But remember, for you as an investor, you can't tell which company that is today, right? And that's why one thing we insist is that once you start, it has to be a journey where you're trying to create a portfolio, right? Where the portfolio feeds off from each other. This company adds value to this company, etc., right? And even if some fail, some will make it, etc., that kind of thing.
Wow, really interesting. So I think we're clear in terms of, for an investor, what to do, what to start looking for, how the valuation is done. But for an entrepreneur, as we bring this to sort of a close, what are some of the things you would let entrepreneurs know beforehand as they prepare to come to, look for money for their business?
That's also a tricky question. in this ecosystem, what I've learned is that there's so many nuances around it, right?
Okay.
So number one, in the Kenyan ecosystem, there's a whole debate that's happening, first of all, in terms of local founders versus expat founders.
Yeah.
And the access to capital for local founders versus expat founders.
What are expat founders?
Expat founders are, pretty much people who are not Kenyans who've come into Kenya and have founded businesses.
Oh, you mean like expatriate
Yes,
founders?
Yes. Expatriate founders.
Yeah, I've seen that debate.
Yeah, and there's a whole debate there. And the reason why I say, there's some common things that everybody has to do. Yeah.
Okay.
But there's some things that I feel that local founders have to do more, if you want to ask it from that perspective. So let's try and unpack this. So I think for local founders, number one, traction is very important, right? Traction is very important. People want to see what have you done, show us traction, right? Number two is the story. The storytelling has to be really good. As I told you, you know what, if you start out today and there's, you've done barely nothing and valuation is $5 million, you're really having to convince people, why is it $5 million? And it's all about the storytelling, about painting the future, painting how big the company is going to be in the next 5 years, whatever, 10 years. How are you going to expand across the continent? So the storytelling is such an important bit. So invest a lot of time in terms of your deck and the storytelling bits around that. So that's very important. And I would also say the team you've assembled is also such a critical thing. Because you see people are buying also into the team because there's really nothing else to buy at that point. So it's about, what's your background as a founder? Is it a sector you really understand? What kind of connections do you have in this space, etc. So, the team, the story, the level of traction helps a lot in terms of pushing that, right? And then the other thing that I would just say is that also capital is not only local, right? There's local capital, but most of the big rounds of financing are also not being raised locally. So if you can spare that as a local founder, and you can sort of hop on a plane, do a journey across Europe, do a journey across the US, and I mean the beauty is that if you speak to different incubators, accelerators, they can connect you to these places. I feel like that helps a lot in terms of getting to the investors and having those conversations directly. Yeah, and the reason I was saying that at times I feel like maybe the rules don't apply maybe as equally is that for expat founders they have that advantage that a lot of capital is not coming from here, and so they can pitch directly from where the capital is coming from. Their VCs understood much better. So when you say that you're raising at a $10 million valuation, nobody is sort of worried about what you're saying, right?
We've run out of time, unfortunately, but this is such a fantastic conversation. And thank you for taking the time to just educate us on, what venture capital is, the opportunities that exist. I think for me, the biggest takeout is you don't just jump in and become an angel investor, give your money and hope that it will just do well. The question I need to ask myself before I invest is, what value am I going to add to this so that I can generate value from this opportunity? That was, for me, a really interesting statement that you made, which is the truth. We've been speaking to Stephen Gugu, who is the founder of InVhestia Africa. He's also the founder of Victoria Ventures, which is an angel network. And he has shared the websites, and we can go online and just learn about it a bit more. But if you haven't subscribed to this channel, please do. You are watching the ICIFA Investment Show, and we will be having more shows every 2 weeks. So stay tuned, subscribe and share the videos as you see them so that more people can learn. God bless you guys so much, and have a wonderful day or evening wherever you're watching from. Bye-bye.